Strategic Wealth Strategies podcast with our host, Alan Porter. Alan, what's going on, man? How are you?
I'm doing great. It is an absolute beautiful day here in North Carolina. Sun is shining and going to start playing my member guest golf championships this week.
Oh, it's going to be a lot of fun. And today's topic, why the wealthy cash value life insurance is their private retirement bank. Most people think of life insurance as just a death benefit. Why the wealthy look at cash value life insurance so differently?
That's what I thought too, Neil. But that's what got me into this business. You remember I had some tragic things happen to my family. My daughter-in-law died at age 39 from pancreatic cancer, and my son had been disabled 3 years. There was no money coming in the family except when I was helping him out. But she had a terminal illness rider on her life insurance policy to let her access the death benefit, which was in the hundreds of thousands of dollars, completely tax-free. And if it had not been for that, my son would be bankrupt, and it took a huge financial strain off of me. But that's one of the main reasons I got into doing what I'm doing right now, and that's why I have such a passion for it. But to answer your question, that's true. Most people only see life insurance as protection for the family when they pass away, but you can use it while you're alive, while you're dead. But the wealthy view cash value life insurance as a living asset. And I do too. I become my own bank. But it's just not about the death benefit. It's about building tax-free income, which is absolutely huge in retirement, liquidity and protection during your lifetime. If you got money in a 401k, you have no liquidity at all. In fact, it's one of the best kept secrets of the ultra wealthy for growing and protecting wealth.
How does cash value life insurance actually work as a private retirement bank?
Neil, I've been doing this for over a decade and a half. But when you put money into a cash value life insurance policy, that builds up your cash value, which builds up the ability to borrow from it. And when you borrow from your cash value, now understand there's two piles of money in your life insurance policy. There's your cash value, and then there's the death benefit, which is hundreds, if not millions of dollars more. And when you borrow from your cash value, that particular account continues to compound. When you borrow money from it, it does not affect that. What that does, it puts a lien against the death benefit. You don't even have to pay the loan back if you don't want to. It just comes off the death benefit. And actually, that's what the insurance company would prefer you to do. But Neil, I bought two new cars in the last 2 years. I have done this for the last decade and a half. And I'm going to pay myself, think about this, Neil. If I was making a payment on a car, let's say it's $1,000 a month, and I took it out from paying interest on a car loan from a financial institution or a bank. When I make that $1,000 payment, that money's gone for me forever. It's going to compound for the financial institutions forever or whatever they do with it. But for me, it's gone. So what I do is I pay myself. And not only will I have a car paid for, but I'll have tens of thousands of dollars more in my cash value. And people need to understand this. And what it does when you do that, Neil, when you borrow from yourself and pay yourself, you're compounding interest for yourself and not the financial institutions, and you're eliminating the effective interest costs that you pay on the money you borrow. And people don't understand what an effective interest cost is. It's absolutely huge. And this is what keeps people in debt. I had a gentleman that had a 2.75% mortgage, and he thought that was pretty good. When I did my debt-free retirement plan, I said, you got $461,000 in debt. That's not your problem. The problem is the 49.76 effective interest cost you're paying on that money. And he said, I have no idea what you're talking about. I said, and he said, how is that even possible, Alan? I said, because it's not going to get down to the 2.75 until the last couple of months of the mortgage. I said, you got a credit card here that's over 90% effective interest cost. Now, Neil, I want you to think about 87% of the people in the United States are living paycheck to paycheck, and they've got credit cards. They're never going to get out of debt just paying the interest and a little bit over, because 90% of credit cards, in the vast majority, is going to effective interest cost, compounding for financial institutions and not you. But you become your own bank. Give me a call and I'll show you how to do this.
What makes IRC code 7702 so important in protecting the tax advantages of these policies?
7702 and 70E are tax codes that defines how life insurance policies are taxed. As long as the policy is structured properly, it qualifies for special tax treatment. Your growth is tax deferred. It does not affect the taxation of Social Security or the means testing for Medicare Part B. Your loans are going to be tax-free. That's why wealthy families love these tools. It's backed by decades of IRS law. It's also a social benefit. That's the way the government looks at life insurance. But Neil, not only does it grow tax deferred, tax-free, it can be a tax deduction when set up properly in, say, a defined benefit plan. And as I said, it does not affect the taxation of Social Security or the means testing for Medicare Part B, which will be in the thousands of dollars per year. And for the average individual, that's extremely important when it comes to retirement. But the wealthy use it for many other reasons.
What are some real benefits wealthy families get from using cash value life insurance compared to relying on 401ks or IRAs?
First off, there's no required minimum distribution. You're not forced to withdraw and pay taxes. Again, it's tax-free income. Another huge thing is protection from market downturns. See, cash value life insurance Neil, it eliminates or mitigates all the risk in retirement that a stock portfolio only covers, such as sequence returns risk. The number one fear in retirement is running out of money before you run out of life. Longevity risk, which is a risk multiplier. It eliminates market risk. It eliminates tax risk. The list goes on. And all a stock portfolio does, or money market fund or CD, all they do is compound risk in retirement. Neil, it's not about rate of return in retirement. It's about distribution of your assets.
How do banks and Fortune 500 companies use these same strategies, and what can individuals learn from that?
You can go to FDIC.gov and you can see every major asset of every major bank in the United States. And cash value life insurance is their top tier one asset. It's more than twice as much as real estate and almost 10 times as much as stock portfolio. But bank-owned life insurance, it's called Bull Life. Bank-owned life insurance corporation, so it's corporate-owned life insurance. And they have billions upon billions of dollars in these vehicles. And I tell people, I said, the banks are supposed to have the greatest financial minds in the world. And if they think cash value life insurance is an important asset to have in their portfolio, don't you think you ought to have it in yours?
100%. It's unreal when you think about the savings and what you can do using this and why other people don't. Alan, before I met you, I never knew about any of this stuff, what you've been able to teach me.
You know, the other thing, Neil, why wealthy? Now, I've got multimillionaire clients. They've got hundreds of millions of dollars, but they've also got hundreds of millions of dollars in life insurance. They don't need the life insurance. They got plenty of money and assets, but they need a wealth transfer vehicle. As far as I know, properly constructed life insurance policies are the greatest wealth transfer vehicle available. Because I'll give you a perfect example. The Prince, the entertainer that died a couple of years ago, he had no exit plan, no will, no trust set up. And his estate was put into probate. And I got a definition for probate. It is a lawsuit that's initiated by you that you're going to pay for and you're going to lose. Because what the government does, they come in, they confiscate all your assets, and then they pay the taxes on your estate, and your beneficiaries get what's left. And the other bad part about this, attorneys get 6 to 12% of that. So Prince's beneficiary may get 20% if they're lucky. It's really crazy. But you've got to have a plan, like I've told everybody. You've got to have a will, a trust set up. If you don't, get it, and then review them yearly.
If someone wants to explore using cash value life insurance as part of the retirement strategy, what's the first step they should take with you and Strategic Wealth Strategies?
One of the first steps is simple. Just go to my website and try out my retirement tax calculator. It will show you how, your potential tax bill in retirement. They'll provide you a no-cost report. But Neil, here's the other thing. The big thing is make an appointment with me. Call me at 910-551-1046 or go to my website, strategicwealthstrategies.com, or on my email, make an appointment with me. It's strategicwealth0@gmail.com. Now, Neil, I'm all about education. I do not charge my counseling services. I want to educate people and think outside the box of conventional financial planning and create a paradigm shift in their thinking.
All right. That was the Strategic Wealth Strategies podcast, guys. Take